Oh, wow. Is that a new intro?
What happened?
Mike, were you watching?
No.
I don't know. There was something new going on. I feel like Duncan and John are always cooking up some new stuff.
Yeah, are you farming this year?
Farming what? On Acre Trader?
No, legit.
Should I be?
No, for real. You farmed last year. You did some growing.
What did I farm?
You grew basil and tomatoes?
Not farming.
Did you or did you not grow basil and tomatoes?
I talked to Tony today. Yeah, I'm gonna run it back. I'm only gonna do basil and tomatoes this year, no peppers.
So
but yeah,
I have a big garden every year. I farm. No soybeans this year. It's too rich.
Can I stop you? You're not farming. You're gardening. It's okay.
I don't know what the difference is.
Really? You don't know the difference? You don't know you don't live on a farm? Are you kidding me right now?
Anyway.
Do you have animals involved in your production?
I have a dog and 2 children.
Okay, it doesn't.
Check out Acre Trader if you want to invest. My farm is not yet on the website. Maybe one day.
Oh, I see what we're doing here. Listen.
Come on, it's called shtick.
Farming is serious business. Gardening is a hobby. Do you have should I get basil from you? Do you have like a good, I don't know, is it called a strain?
I go a strain. Yeah, I go to Ace. I go to Home Depot and I get the pre
just buy the package.
I do the toiling or the tiller. What's that thing called? Where you like up the soil.
Listen, do you?
I motorboat the soil. Yeah.
Do you? Are you in? Like, are you in the soil yet, or is it too cold?
Nah, I don't know. No. Mother's Day.
Mother's Day.
Tony Isola taught me that.
Okay. All right.
Got
very
peppers.
cool.
Got it all.
Well, listen, shout out Acre Trader. There's a link below us if people want to check it out. Investing in farmland is not necessarily something that you want to do on your own. You don't want to just be randomly cold calling farmers and see if they want to sell land. But there are a lot of positive attributes to investing in farmland. So be sure to check out Acre Trader. Welcome to the show. Shout out a couple of people on the stream before we get into it very quickly. Somebody said the new coach of Maryland, I assume University of Maryland, looks like Michael Batnick. I don't know who it is. So maybe Duncan will pull something for later on, and we could take a look at that. Who else is in here? Sam Chisholm has been here. Kenyon LaPierre. Debbie Dantes.
Basketball coach or what?
Yeah.
Lacrosse?
I think that's what they're referring to. I think that's what they're referring to. I don't know. We have all kinds of people here for the live tonight. Warren Z, what's happening? Rachel, we love you. Thank you so much for coming.
I'll tell you what's happening. You know what's happening? Look how
what?
Look how light it is outside.
Yeah. What does that mean? Is that good?
Turning the corner. We're turning the corner.
We're almost there. Okay. Speaking of turning the corner, huge week, or maybe week and a half for the crypto markets. And you and I really haven't been talking about this a lot because it's been kind of boring. I felt like Bitcoin was trapped in this high 30s range-bound sort of trading, not really going anywhere. But this looks like a breakout to me, or at least a breakout of a downtrend. What's happening here?
ETH is up 15% this week. Bitcoin's up 8%. You know, I was about to take out a chart and draw some lines, but I didn't. Yeah, so ETH, it looks like it's like we get chartists
we have some charts in the doc.
Hang on. Okay. But chartists draw like triangles. They draw like this thing is that a wedge where it's basically like it's coming to. There's got to be some resolution. It's been going sideways in a smaller and smaller range, and it looks like it's resolving to the upside.
Bull flagging, would you say?
You could
almost say maybe potentially.
I wouldn't quite say a bull flag because to me a bull flag is when it does this and then goes sideways.
All right, before we get to the price action, let's do my crackpot theories. I threw this in the doc. I don't know if you had a chance to read it, but I think this is my opinion. Why is Bitcoin breaking out? Yes, the whole Nasdaq just rallied too, and those two things seem to be correlated lately.
Yeah.
But Ukraine, forget about Russian oligarchs trying to use Bitcoin. I don't believe in any of that stuff. Ukraine is the first world use case for Bitcoin as a portable store of wealth that would really resonate with people in the middle class of Western civilization.
Canada too, to a lesser extent.
Fine, but people like you and I watch the TV. The Ukrainians look like you and I. Their kids look like our kids. They're wearing SpongeBob backpacks, and they're like dressed like us. We're not quite Eastern European, but I'm just saying, like,
I am.
it's not the same as like, oh, Venezuela, they're using Bitcoin to get their money out. It's harder for me to relate to personally, and I think it's harder for New Yorkers to relate to. But when a European capital is being bombed and you see women and children that look like your wife and your kid, all of a sudden I feel like it clicks with you that not that we think this could happen here, but oh, that's why there has to be a portable form of money just in the world in general, because horrible shit does happen. What do you think about that take?
Yeah, no, I totally agree.
It's a very Eurocentric, middle-aged white guy take, but like that's my take.
I agree with the premise wholeheartedly. We were talking with Allison, and I said this might be a watershed moment for crypto, like what's going on now. The problem is I don't know if that's responsible for the rally because it didn't rally on that news, not even close. And I think it's more just a function of risk is being back on. I think it's more like shit's bouncing.
Oh, that could be. I'm just making shit up, but like I was like pointing at the screen and I was saying to myself, that's that shit where it's like, oh, this is what I would use Bitcoin for. Like in real life, I would use it for this. I would upload as much of my capital as I could, run over the border to Poland, and then pull that shit back to my phone when I need to spend it. That's what I would literally do. Okay. ETH reclaimed 3,000 for the first time since February 17th, 2022. All right, so not that long ago, but it got down to as low as 2,200, I want to say. It got pretty low.
It got as low as I see 23 back in whatever.
All right, so this one has its own story too. We're on the verge of the threshold of ETH 2.0. They're on the last, I guess, testing server before they really move the whole thing up.
I don't get any of this. All this is freaking.
So what they're doing is before they make it proof of stake.
Stake, yeah. No, I know.
Instead
I know
of
what
proof
they're
of
talking,
work.
Yeah, but I still, yeah.
They're testing it before they merge the two things, and then eventually there will just be one ETH again.
No, so I understand the story about the transition, which has been happening. They've been talking about it for a long time. I'm saying I don't know technically. I have no idea how the.
Oh, no, nobody does. God himself couldn't explain it technically, but this is what's important.
There's like nodes and shards.
But this is what's important because there was no upper limit on how much ETH, which is different than Bitcoin. The idea that the community had was we're going to burn ETH when it's used, and so they've actually burned 2 million ETH, and that looks like it's the equivalent of $6 billion US dollars. So that's important. And then on gas fees, it looks like still not great.
No. Way down.
Oh, is it way down? Okay.
As somebody who's still messing around with NFTs, the gas fees are way down.
How does that happen? Just more efficient networks?
I think so. I think that there's less demand because the volume is less than it was. And I think so it's a combination of that and more efficiency. By the way, speaking of drying up, we haven't gotten a single email, Animal Spirits, about crypto in, I don't know, months.
Yeah. Because it's not
moving.
Because it's not crashing.
It's not moving.
And it's not running.
It's not moving.
But don't be surprised. Now you might. All right. So gas fees come down.
Time out. Don't be surprised. I told you I saw this pattern. You don't be surprised.
I won't be surprised. The amount. Where is this? The amount of ETH needed to process transactions has dropped 94% since January, lowest level since August of 2022. Throw this chart up. Explain this to. Explain what I'm trying to say, but like somebody that actually knows what they're talking about.
Okay, so I really don't know what this is. What are we looking at? Ethereum transaction fees dropped to a 6-month low. So isn't this exactly what's happening? Is that they're getting more efficient? They're
more adoption.
They're doing
and
more
the transaction
with less?
fees fall. Yeah.
So good.
That's what should happen.
Good.
So despite the fact that there aren't big price rises or big price drops in the layer, right, in the coin, there's still enough activity so that the cost of running things on the network is falling. Which, if you're going to do DeFi and you're going to do NFTs, that's what has to happen.
Let's show this chart first. Let's look at transactions per day. So, okay, off the highs, but still pretty steady. Now, and then next, let's go to the average gas price. Boom shakalaka.
That's what it should do.
There we go.
What is that 30? Is that why does that $30 level seem like it's some sort of a floor?
Well, I guess it can't go to zero. Although it looked like it was pretty damn low prior to NFT mania.
Okay, that's really interesting. What's this next one? Transactions per day, percent off high. So we're in a 32% drawdown from the high of. What are transactions though? Is it moving it?
I don't know. This is a weird chart. I prefer the other one. I think the transactions per day tells a cleaner story because this makes it look worse than it is, I think.
Okay, so let's just get into this test net thing because it's very, very timely. So the last test net, a test net is like where they're running this in parallel with the regular Ethereum network. The last test net, I guess, is called Kiln. Please, guys, I'm not speaking on this authoritatively, so don't go at me if I misexplain something. But I think this is relevant. This is like the final hurdle to be able to say we have now fully transitioned the Ethereum network from proof of work, which is horrible for the environment and requires a lot of excess computing power, to proof of stake, which maybe makes it a little bit more centralized, right? Because you have whales, just like you have in Bitcoin, but overall is probably better for the environment, less computing power being used, and maybe it's a little bit more forward thinking. So we're right there. And I think this whole thing wraps up in the next week or two. From what I've been reading,
sources are saying.
Well, I mean that's what the reporters who are covering this space are saying. The last thing I wanted to ask you on this, I know there are new NFT things that get hot like every week or every 2 weeks. I don't know how much turnover there is.
It's been pretty dry lately.
All right, so the Bored Apes thing seems like it's. I mean, it's not going anywhere, but it seems like people are bored, and it looks like volume is dropping off. And prices paid are starting to fall. So let me you're shaking your head, but let me read it to you anyway.
Well, your article's stale. Your shit's stale.
It's from when? The end of the beginning of March?
Stale.
Middle of March?
Stale.
Okay. February, there was a fall off, which I think maybe coincided with the stock market falling.
There was.
So is Bored Apes, all right, so at the January peak, Bored Ape Yacht Club recorded 815 unique buyers. Total transaction count of 1,063. Those figures failed to be repeated the following month with only 301 unique buyers, resulting in only 352 transactions. The reason why I think this is really relevant and really important is whether you like this stuff or hate it or think it's stupid, it is the primary use case right now, I think, in most people's minds for what crypto is gonna be and is going to do. Like it's working today. It exists now. And I do think that there is some correlation with high growth stocks and these sort of collectibles. And it sounds like you're about to agree with that.
Well,
for now.
So let's throw up some of these charts. Let's just take them in order. So on top, you've got the volume. So yeah, there was a spike early on. And what the purple chart is showing This
is apes being traded on OpenSea?
Yeah. And the purple chart is current, like how many people own 1, 2, 3. Most people just own one ape because they're so freaking expensive.
Yeah, it costs a lot of money.
But the next chart invalidates what you were talking about. So there was a big drop off when that post was written. Yeah. And then there was the spike because Yuga Labs, which I think is the founder of Bored Apes, bought CryptoPunks. And there's this whole thing going on over there. So Joe Popliato tweeted this morning. This is wild, or just an hour ago, I should say. So Yuga Labs, the creator of Bored Apes, is now valued at $4 billion. They just raised $450 million. In 2021, they did $138 million in revenue. Yeah. Their net profit, $127 million.
That's amazing.
Company was founded 14 months ago and had only 11 full-time employees in January.
So their profit margins are 95%?
Pretty much.
Is that what you're saying?
Pretty much.
That's amazing. But so now, all right, so from my perspective, now the thing is, so they caught lightning in a bottle. It's amazing. Congratulations. But now you're going to scale up. You're going to hire people. You're going to raise all this money. You have investors.
Yeah.
Now you have to catch lightning in a bottle twice. Is that likely? Can they come up with the next thing that's going to do this? Or can they ride this thing forever?
Dude, I don't know.
I don't know either.
Yeah.
Like, it's a very big question, though, if you're part of the investor group that put money at a $4 billion valuation, is it not?
I saw a video that they put out the other day that looked pretty sick. I don't know what they're going to do with the IP. I really don't, we'll see. We'll see. It's
All
a
right.
fascinating story. Let's move.
All right, let's
we good?
let's go back. Let's go to year to date. Let's go year to date Ethereum really quickly. So still down 22% from the high.
Yeah, but
Did
one
you-
ETH. But one ETH is still one ETH. So you got to keep that in mind.
Have you been averaging down all year?
Yes.
Okay, I think I'm just doing it now in our crypto index.
Well, I do ETH on the weekend and Archery during the week.
Okay, I like it. I don't hate it. The only two that I'm buying on their own now are Solana and the Graph. Is that right? No, Polkadot, because neither one of them are in our index.
Solana now is.
Now it is? Okay. So I should stop. All right, Bitcoin down 13% year to date. Not terrible considering the carnage for almost anything technology related. And this looks like it's, I mean, I don't know. I see higher lows. Do you see the same thing? I know this isn't candlesticks and
Barely.
it's not that.
Yeah.
Okay. Gold. Gold and Bitcoin sort of, kind of heading in the same direction. I don't know what the correlation is right now.
No.
You don't think so?
No.
They're not both going up after having after starting the whole year rallying?
They look nothing like each other.
No? Okay.
No.
Let's throw up this Archery chart. So remind me, how many cryptos are now in this index?
Now we've got 15.
Okay. So this is since inception. You're showing me negative 23%?
Yeah, this is non-public. Get that off my screen.
Okay. All right. Sorry. Oh, I didn't know that. It's not the index. The index is published.
Whatever. Anyway, we're
Wisdom
down.
Tree publishes it.
Yeah, it's down. It's down. Obviously.
Okay. Okay. I think that one of the most interesting things about the way that crypto has been acting this year is this breakout. Like, it was getting very boring, and I had noticed
Super boring. You know the cartoon Do Something?
Yeah, but so here's what I want to ask you: what happens if they rally them? If they rally these coins like hard,
And then
but they don't retake the old high before selling off again?
I don't know.
Because that's already happened once recently. Like I feel like this is the type of thing that has to retake the old high, or else it presents.
I don't know, but I can
it
feel
presents
people-
another crash opportunity.
I feel people getting bored, so let's move on.
Okay, all right, let's go next. What do you got?
Okay. Nick Majuli did this really great post on what happens when we got 10-year declines. So he said since 1915, there have been 29 separate 10% declines. Of those 29, the Dow had a positive return over the next year in 20 cases. So therefore, statistically, now these are just statistics, there's a 69% chance
Nice.
that following a 10% decline, the market would be higher 1 year later. But what I want to show is some of the data that Nick did. So let's start with future returns from all-time highs. Perhaps counterintuitive, but all-time highs, not only are all-time highs not characteristic of a bear market, as my friend JC would say, they're actually bullish. So from an all-time high going forward, the median 1 year return is 9.6%. Okay?
Okay.
Excluding dividends, just 9.6%, just price returns. Once you're in a 10% drawdown, chart on. The returns are only half as good, which I thought was very interesting.
How
The
can that
median
be? Doesn't that sound like it doesn't make sense?
Hang on. The median 1 year forward return, once you're already down 5.5%, once you're already down 10% is 5.5%. Now, this is not average. It's the median. So let's just do a side-by-side, chart on, chart off, just real quick. There we go. So you see with this one, the left tails are much fatter.
Okay.
So, Joshua, I think why this is counterintuitive is that if you were to extend your time horizon 2 years, 3 years after a 10% decline, you would probably skew much more positive.
So I think the message here is just because the market drops 10%, that doesn't mean your returns automatically would go up over just a 1 year period. And in fact,
It's the
that
opposite.
could be indicative of a market that's going to get worse before it gets better.
Because by definition, all bear markets start with a 10% decline.
Right. Okay.
Right?
So I
And so-
think most people, if you ask most people to guess what buying at a 10% drop does versus buying at a high, like the average person that doesn't really know that much would be like, well, yeah, I'd rather buy down 10%. And then it's like, okay, yes, but not inside of 1 year. It doesn't end up benefiting you. I think that's really interesting. Buying highs, generally speaking, on the Dow means you're buying during a bull market.
Yes.
Is the other obviously.
And bull markets tend to persist, generally speaking.
Okay, Nick had a ton of charts in that piece.
Some real good ones there.
So this is called Great Depression or Bust. If anybody wants to go check that out on Of Dollars and Data, which is Nick's really fantastic. Scroll down. Can we scroll this?
That's a screenshot.
Oh, screenshot. Okay. All right. If anybody wants to check out Nick's blog, feel free to go ahead. Flattening yield curve. I think this is the biggest story of the week.
Yeah.
Economically, at least you wrote about the worst run for bonds since 1980, and I just wanted to, I guess, have you coming out of the locker room, the post game, tell me what went into this post and what you were looking to find, and what were some of the discoveries that you made, because I thought this was really interesting.
All right, so I won't pretend to understand exactly what's going on. In fact, I'd love somebody who really understands who understands the bond market to explain to me at different maturities what's going on. It's a bit wacky. So basically, last year, let's hope this first chart of the yield curve. The thing is, as has been discussed, and no, I'm going to.
Okay.
So the yield curve is the Treasury issues bills, notes, and bonds with different maturities. They go from as short as 1 month all the way out to 30 years. So when you plot the yield at different maturities, that creates what's called a yield curve. And typically, that is positively sloping because if you're going to tie up your money for 10 years versus 1 year, then you want to be compensated for all the different risks that are inherent in that unknown 10-year time period. And so when the curve flattens and inverts, it's generally not a good thing. And so this first chart shows that every time the yield curve has inverted ever, a recession followed, I think between 6 and 24 months later.
Mike, let me jump in really quickly. So this is the 10-year Treasury minus the 2-year Treasury, and that black line when it falls below, when the yield curve falls below, that is an inverted yield curve, meaning actually the 2-year has a higher yield than the 10-year, which is unnatural, and that basically basically indicates that the market does not believe there's going to be economic growth in the future, or there's going to be a slowdown, and people are becoming more risk averse. Okay, go on.
So what's interesting is for the first time, in a really long time, we're seeing fund flows out of bonds, and it's happening at a really uncomfortable time where you've got inflation keeps going up. So you've got real negative returns all over the place. You've got people selling stocks. You've got people selling bonds. Maybe they're selling stocks because they're selling bonds. And it's just a weird sort of dynamic that's going on. So if you look at the U.S. bonds rolling 3-month return chart that I made, we're seeing the worst 3-month return. This is just nominal total return. We're seeing the worst 3-month return going back to the early 80s.
This is the U.S. This is the aggregate bond index, which represents all the treasuries and investment grade bonds.
Yes. So what I would say is a few things.
Mike, we're down 5% in how long? 3 months?
Yeah.
Okay. So a 5% drawdown in 3 months, as you can see from this chart, is very rare for a portfolio of treasury bonds. It really does not happen very often. And in fact, just squinting, you have to go back to 93, 94 to find another 3-month
80.
period. Go back up. You had a moment, 94.
You had a moment in 94. Yeah.
Yep. Okay. Continue.
So you've got this. Where was I? You've got
You
this.
Want to show people the yield curve, the actual flattening?
Sure. Yeah, throw that up real quick. So
right.
1 year ago today, everything was pinned to the ground. And now we've just seen a big steepening in what's called the belly, which is the middle of the curve, rising up. And so you're not being paid really to take on more duration risk. So I think the 5s might even be below the 10s or thereabouts. I know 20s below the 30.
2s, 5s, and 10s are very, very close to each other in terms of yield, which is a flattening yield curve.
It's all weird. So we're going to tie this together soon. Let's just throw up this growth of a dollar chart. So to which I would say, like, all right, come on. Things have been really, really, really good for the U.S. investor. Like really, really, really good.
This is a growth of $1 in a 60% stock, 40% bond portfolio.
US
It's pretty badass.
U.S. only. It's been one of the best risk-adjusted portfolios ever. Let's throw out this drawdown chart. So all right, it's really not that bad. And then so yeah, it's been the worst 3-month return ever. But again, context matters. It's down 5%, right? It's like a bad afternoon for Twitter or whatever.
But don't you also think though, we've just had this furious 5-day stock market rally. If people are selling bonds, they're not going to sit in cash forever. They're reallocating. They're basically saying, all right, the Nasdaq's down 25% and I'm going to get killed earning a 2% interest rate with 7% inflation. Fuck it, buy me the FANG stocks. And that, I think, goes very far toward explaining the comeback this month.
So rising rates are now bullish for stocks?
Well, we are in every day is opposite day. I mean,
so the reason why this matters is this. And the reason why there's a silver lining here, yeah, it sucks. Nobody's used to seeing their bonds go down in value, right? If you've been investing for the last 30 years, all you've seen are bonds appreciate over time. And for the last 10 years, people have been rightfully upset because their fixed income isn't providing any income. And that's the whole idea behind bonds. And if we want our fixed income to go up, then the fixed portion has to go up. And the only way, and so unfortunately, you got to take a couple steps back to move forward. So let's throw this next chart up. So the only thing that really, really matters for forward returns for bonds is the starting interest rate. I made this chart a year ago, and it shows the average 10-year rate in red, and then the black line is returns fast forward to 10 years. And you see it basically tracks 1 for 1, and the next chart shows it even better. Okay, so basically starting yield, you know where your forward returns are going to be. So it's painful to adjust and to get to this place.
Let's go back to that. So explain that. There's no relationship in finance that's quite as reliable as saying whatever the starting yield of a treasury portfolio is, that's a pretty good indication of what your average annual return will be over that period of time.
Correct. With the stock market,
that relationship is really important.
There's not 1, 2, or even 10 combined variables where you say, okay, if X, then Y. If this, then that. There's nothing that exists like that in the stock market. With bonds, it's very, very different. You know your starting rate. You have a pretty good idea of what your forward returns are going to be.
So if I buy, hold on. So if I buy a 10-year treasury at a starting rate of today at 2.25%, after 10 years, there's like a 95% certainty that I will have received roughly 2.25% per year as my average annual return
before inflation.
Of course, in nominal terms. So that's a very solid relationship going back like a century.
So things have been very easy for a 60-40 portfolio investor. And by the way, since I made this chart, you're right. Stocks are up like 7%, so it's all good.
Yeah, it's all fixed. As long as you have both, and you're not, I'm a bond investor or I'm a stock investor, and that's theoretically diversification should work because people have to invest in something. Like you can't be 0% stocks, 0% bonds for long. I don't care if you're a person or a pension fund or an insurance company. You're going to invest in something, and the herd always finds somewhere that they would rather be when they get out of one asset class. Let's do this Powell thing very quickly. I'm reading a lot of hilarious takes that he's the new Paul Volcker. I don't quite think he's that hawkish.
Who's saying that?
I'm hearing this is a Volcker-esque moment for Powell where he's going to slay inflation. He's not even at neutral, let alone tight. Not even at neutral. This is Ethan Harris at Bank of America making this point. A final question is whether hawkish central banks will kill inflation. Globally, we see GDP-weighted policy rates rising from only 2.3% at the end of 21 to 3.2% at the end of 22, 3.6 at the end of 2023. So that's all of the central banks in the world. If they go to where consensus thinks they go, they're still under 4%. That's not quite tight policy. Given the rise in inflation, this is hardly hawkish behavior. We are particularly struck by the misleading commentary around the Fed. After the Wednesday policy pivot, the press warned of an aggressive policy shift and the Fed prioritizing inflation over growth, taking a step back. the Fed is only being aggressive relative to the highly unusual dovishness of the last year. It is not pivoting to fight inflation. It's pivoting to neutral. So even if they do a 50 basis point hike, it's not like this is a Fed that's on the rampage. We're not even at a neutral rate at this point.
We're still
an important point.
We're still very far behind, but where's the line? You knew we could get to 3%.
We couldn't get to 3% during the last hiking cycle. Now, granted,
this is very different.
There wasn't as much inflation, so that's true. Can we do 7 hikes without having a recession? I don't think so. Hope I'm wrong. I can't imagine it. So, especially
you can't imagine being wrong.
No, can't imagine them doing 7 hikes inside of the next 2 years, and with a yield curve that's already inverting and not having a recession. So maybe it's possible. The big mitigating factor is, do commodity prices calm down? And if that's the case, maybe they don't need to do 7. So it's almost like a circular. So it's almost like elliptical, the whole concept. So what is this? Target rate probabilities.
Oh,
let's throw this up.
So people are pricing in for the May meeting a 50 basis point rate hike. What does this say? A month ago,
there's no April meeting.
A month ago, it was 46% back in February. Now it's up to 61% probability that they're going to go.
These traders are geniuses. Maybe it's because he said 50 basis points.
All right, well, whatever. That's so okay.
Okay.
Right.
You're up.
Was that the bottom?
No. Next. You think it was? It could be. I don't think so, but
I wouldn't. I mean, dude, I know there's a cop out. Nothing would surprise me anymore, given that oil went negative is like my standard answer. But I mean, I'm surprised.
Come on,
all right,
commit.
so here's the deal.
Commit.
What?
Commit. Bottom?
Do I think? No.
You don't think so?
No.
Ooh.
I think it might be like a bottom for like a couple weeks.
Oh, bottom. Yeah, I'm with you.
Yeah,
I'm with you.
I don't know this is the bottom.
We could trade off this for a while, though.
Well, you have to give yourself a time frame. I mean, obviously, it's not the forever bottom. I'm saying that it's a bottom. It'll hold for like a couple weeks.
I don't have to give myself a time frame. I'm saying that's not the low. That's not the lowest low before we make new highs.
Well, if that's the low until a year from now, you're wrong. I think.
Okay.
Yeah.
All right.
I mean, we got to define these times. So I think that this low will hold for 16 days. That's my take. All right. So the deal is this. I think this matters. I really do. Here's some sentiment trader. The Nasdaq Composite fell to a 52-week low and then surged at least 2.5% on back-to-back days. That happened 5 other times in history. 4 of those marked multi-year lows. Now, you might think that's cherry picking. I don't. I think a data point like this actually matters because this is investor behavior, which is repeatable by and large throughout history. Again, what this is showing is back-to-back 2.5% gains following a 52-week low, which means massive buying off of depressed prices. So generally speaking, that's been good for a bottom.
So this is just, guys, this is NASDAQ. This is not S&P. This is not Dow Jones. But I think there is some consistency to the type of people who are involved in NASDAQ stocks over time. So I do agree with you. There's some information here just about how traders of growth stocks tend to act after those types of events. Yeah. I do think there is something there. Now, I wish we had, an extra 50 years starting before 1970, and I wish there were, 5 or 10 more instances of this, but maybe there will be in the future. So look, I think it's reasonable to say that the bulls have retaken control of the market, but it's so fragile. Like you really don't. You have one bad day, and a lot of people throw in the towel all over again. So I think it's been a great week. We can change. Let's just enjoy it. A lot of stocks that people have been killed in have gotten new life, and hopefully they're using this time to adjust areas of their portfolio where they were taking risks
Sure they are. All right, so Bespoke tweeted mega cap. By the way, chart off for one sec. The fifth time that it wasn't the bottom was in 2008. So yeah, it's nothing's ironclad. All right, mega cap Nvidia is up 25% over the last week. Tesla's up 20%. Amazon and Facebook up 13%. Crazy how much market cap is getting thrown around these days. Concur. just really something else.
So much of this is just the overall size of like large hedge funds and index funds. It's just like these moves, they seem like a really big deal, and they are, but in the context of how much money floods in and out of these trades, that could go on all year, quite frankly, in the current environment. You could say, well, it shouldn't, because how could that be based on fundamentals? Nobody gives a shit. If the stock is going up, everybody wants to buy it.
You know who gives a
shit? If
shit?
the stock is going down, everybody wants out.
This guy.
Well,
next topic.
I would argue he's above the radar. He doesn't care about any of that shit. All right, Buffett finally fired the elephant gun, twice at the same time. This is exciting. This might be it. Like, any one of these big trades could be the last trade. It's like him and Munger. It's like watching Butch Cassidy and the Sundance Kid shoot their way out of the joint. So
nobody knows what you're talking about.
Like 5 people have seen that movie. All right, let's do this first. So Warren Buffett most recently bought an insurance company that he and his family have been invested in for 80 years or something.
No.
They've done some due diligence.
This is a great quote. Berkshire will be the perfect permanent home for Allegheny, a company that I have closely observed for 60 years.
Yeah.
Respect. 60 years.
Warren Buffett started observing Allegheny during the Civil War, and
when he first started looking at Allegheny, they were doing $17 a month in revenue.
I think it's really cool that these things still exist in the public markets. They were like these insurance companies that trade for hundreds or even thousands of dollars per share. There's very little turnover in these stocks, very little analyst coverage. They don't do conference calls. They don't do investor day. They just exist. Like, the public markets have given liquidity, and then all of a sudden, Berkshire Hathaway comes along and snaps one up. And they paid a decent premium. They paid a 29% premium over Allegheny's average stock price over the last 30 days. And they paid a 16% premium to the stock's 52-week closing price. So they weren't out there trying to scoop this thing up for pennies in a market sell-off. They seem to have done the classy thing, the right thing.
You know, it's great. There's like a funky share price because they wanted to back out Goldman's $27 million advisory fee. They're like, we're not paying for that. You are.
Hilarious. It's $11.6 billion. I would say this qualifies as a large deal. It's not his biggest deal, but it's a pretty big big acquisition.
It's our biggest one since Precision Cast Parts in 2016.
Which did not go well. But the other one is even more interesting to me, which is Occidental Petroleum.
This chart's awesome.
Throw this shit up. Bang. What is that? The volume on the bottom?
Why are you asking me? Yeah.
So that's him. That's Berkshire. I could say him. That's not the lieutenants. That's Warren Buffett. That's him hitting the green button. Let's go. So they had warrants already in Occidental from when they started the position that stemmed from a financing they had done for the company that helped them make the very large acquisition they made. So they've been, I guess, like dancing around this situation. And then I think the trigger was what's going on in Europe with the pipelines, et cetera. This is America's largest natural gas E&P. Like, I think they have the biggest proved reserve. So it's big enough to move the needle for Berkshire. It's meaningful enough market cap wise for this to become a significant investment in the investment portfolio. And it's cool to see that Buffett can still step on the gas when he wants to do something. So they were buying and filing as they bought. And I don't think we've seen them do that since Apple. When they ramped up the Apple position. I think it's been a minute. So anyway, it's nice to see the old man is still out there making moves, and that there are things worth investing in this market. And side note, I just bought myself the IEO ETF, which not that this is a Buffett-esque situation. I look at the size of E&P companies inside of the S&P. They're still so tiny. I think they could 5X over the next 3 years and still not get back to where oil and gas used to be as a percentage of the index. That's how tiny they've become. So I am now long the same give or take, the same kind of idea.
Well, you also saw the big volume pickup in Bored Apes. I'm just saying.
Yeah.
Could
So
that be him behind the scenes as well?
You combine those two things, and,
right.
and maybe there's a second part to the trade.
I want to talk about gambling. We had a spirited conversation right after the Super Bowl. You were upset, blah blah blah, about gambling, about all the ads and stuff. And I noticed I was so excited, like over the moon excited to use FanDuel. And I was doing parlays and betting on games and whatever, and I just sort of got bored of it. And I can't be too dissimilar from everybody else. And a lot of people were only there. They weren't there for the right reasons like me. They were there because they got the promos. So these stocks have since gotten just annihilated. I can't wait to see the numbers on what sort of money what their customer acquisition costs have to be, like just ludicrous. So here's the way that I'm still gambling. Chart off, please. I am not doing much in-game anymore. I mean, I'm going to the game tonight, so I'll bet on the game tonight just because I'm going to be there. But I'm doing futures bets. Like I'm betting on like the Bills to win the Super Bowl. I'm betting on who to win the finals. You're
not sitting there during the game and being like, so and so is going to have the first bucket in the third
I was.
quarter.
Right.
I know you were.
And I just got bored.
My kid was doing that. I gave him like a couple $100. I uploaded to. He's on FanDuel also, I think.
Yeah. So it was a lot of fun, and I just not consciously. I just stopped doing it.
So Justin's not a podcast kid. He's like he's a
young.
normal kid. He's a video game kid, but he listens to he likes Bill Simmons. So he's just like, put me on FanDuel. All right, you're on.
Right.
And I asked him the other night, I'm like, do you have anything going on with NCAA besides the tournament? Like, what are you doing? He's like, I don't know. Maybe I'll do something. But he's the same as you. I think the enthusiasm wore off.
Because it was it was so novel. Like, I haven't bet in 15 years. I used to bet with a bookie. You know what I mean? And the fact that it was just the excitement was palpable, and now I'm not excited anymore.
I think there's a hardcore gambling audience that this is still the greatest thing that ever happened to them. They don't have bookies. You know what I mean? Like they don't have to wait till they go to Vegas to walk into a sports book. They still love it. I just don't think that's that big of a segment of the population. So I think there was a lot of experimentation, like with JB Smoove and all these people. Oh, wow, this is cool. But I just don't think you can like sustain that for the general public. I think it's gamblers or gamblers.
Yeah, so I guess my premise was I don't think that DraftKings or FanDuel was going to turn people into crazy maniacs the same way that Robinhood wasn't going to break out.
Oh, you're saying it's not going to turn out to have been that? Oh, yeah. No, you know who it'll hurt? It'll hurt the people that would have gotten hurt anyway.
Right.
Maybe it speeds it up, but these are if you have a problem gambler, which God forbid, it's not great. You're gonna find a way to hurt yourself. So does this make it easier to hurt yourself? I'm not sure.
Yeah, no, it definitely does. All right, Duncan, get in here.
There he is.
Hey
What's going on?
How's it going?
Everything's great. Give us the first viewer topic, if you would.
Okay, can I give you a quick poll that I just did in the chat?
Okay, we're listening.
So I asked if we were going to see Bitcoin 80K or 40K next.
Are you now running your own FanDuel?
Wait,
Is that what's going on?
80 or
Is
40?
there money on this?
Dude, horrible poll.
I mean, not 80 or 40, 80 or 20, 80 or 20.
Okay.
And 272 people voted in the chat. 58% said 80K. And then I also said, I went along with your prompt, is this the bottom or have we seen the bottom? 62% of people said no. So
No.
Duncan, good stuff.
yeah.
Okay,
I just
that
figured
makes
out
me
that we
bullish.
could be doing this in the chat, so that's why
That makes me bullish.
But yeah. Okay, so up first today we have a question from Eric who writes, how much is too much for a young investor to have invested in a single stock? We see this question a lot, and so you guys have kind of addressed it before in different ways, but
I think
it's
he's
a
asking
recurring
like
thing.
percentage of his money. He's not asking dollar amount, right?
Yeah,
Yes.
percentage.
Okay. What do you think, Mike?
Wait, this person's he's not talking in points. He's talking in percentages.
All right.
What do I think is the upper ceiling?
And how many points should you make?
I'm making this up. I don't know, 10%?
10% of what?
Your portfolio.
10% of their portfolio, or 10% of their net worth, or 10% of their liquidity.
Portfolio.
Okay, so a young person has $30,000 in their IRA. Pretty good.
Actually, when you put it that way, my answer changes. You can go $5,000.
Three grand in a stock is like, what are we doing here?
You can go 5. That's like 16%. All right, you can push the limits.
So now you are using dollars then.
All right. You caught me.
I'm going to say it depends on the stock. How about that? I think you can own $5,000 worth of Google in a $20,000 portfolio. It'll be a quarter of your money, but I think it's a very diversified business versus like $5,000 in a biotech that's in phase 2 trials and has never commercialized anything.
You know what? That's a great answer.
What do you think about that?
That's a terrific answer. And I actually do think dollar amounts matter. I really do.
Yeah.
Because the higher the dollar amount, the more volatility, the more it hurts to see it go down. So there's all sorts of factors at play. So good answer.
But also like if you, let's say you have $5,000 in Starbucks. Starbucks has had a horrendous 6 months. That stock has gone from 125 to like 80. Like literally horrendous. I think if you have $5,000 in that and you ride that down to $3,800,
Okay.
like you could still say to yourself, okay, but it's Starbucks.
Yeah.
I'm not going to bail now. I didn't bail the whole way down.
If you have
I don't
60
know that
grand-
you could do that in like Matterport. Like I feel like that context matters too in terms of how much money you're going to put in. Like what is the investment?
I was telling Ben, you know what the best inflation hedge is the Starbucks app. So coffee is up 10% year over year. And I am a loyal Starbucks drinker. So I've got like all these stars. And 50 stars still gets me a grande dark roast, whether the price is $3 or $2. So 50 stars is still 50 stars. It is a true hedge.
That's like an ounce of gold will still buy a fine gentleman's suit of clothes.
All kidding aside, that's my
that.
hedge. That's my hedge. Next
we know you're not going to buy. We know you're not going to buy a suit. So
Next question.
Good hedge. Okay. So up next, we have a question from John who writes, I was wondering if you could talk about the relationship between a stock's trailing PE ratio and its forward PE ratio. What does it mean if a stock's forward PE ratio is higher than its trailing? Are these metrics even useful these days?
Well, here's what it means very simply. Let's say that you have a stock that is trading at $100 and it's earning $5 a year, or it has earned $5 in the last 12 months. That would trade at a 20 PE. If analysts expect this particular business to grow its earnings by 20% next year, from $5 to $6, that would put the forward PE under 17 times. So it is a function of the analyst's expectations, which, does that matter? I don't know. They get it wrong all the time. No fault of their own, but that's generally what it means.
not only do the analysts get the E wrong, the earnings themselves for the next 12 months, but they can often get the P wrong, the price part of that equation, because who the hell knows what other investors are going to feel like paying for those earnings 12 months from now.
Well,
It's really hard.
Of course. I'm just saying the formula is determining on what analysts expect the next 12 months.
I think what he's asking is about when he's asking about the relationship. I think he understands the terms. I think he's trying to understand. I mean, I'm making this up, but I think
you would expect to see
the higher, Mike, the forward PE is higher is not a good thing.
That's not a good thing.
Right, because it means that the expectations for earnings are not keeping pace with the price.
Forget about the price. The forward PE changes on a daily basis. It's a function of the next 12 months expectations for analyst earnings. So you should expect the forward PE to trade at a discount to the current PE, right? Because you want earnings to be growing, not shrinking.
Okay.
So when they're trading the other way, when they're inverted, that is generally not a good thing. But I've never seen like a study done on this.
Well, also one other wrinkle.
What's this?
Well, because I think it's important. Certain stocks are actually a better buy when their PE is higher as opposed to lower. Cyclical stocks in particular,
All right, fine, we can get into that. But yes.
Companies like Deere, Caterpillar, when they're selling at 5 times earnings, there's a reason. 5 times forward earnings. The reason is because analysts think that their earnings have already peaked for the cycle. And that's why it's – and then when they're selling it like 30 times, that's because their earnings have bottomed out.
What's that called?
And now are set to start growing.
There's a term for that. I can't remember what it is, but you're right.
It's convexity.
No,
not convexity. What? No, there is a term for that. I'm not sure what it is though.
All right, whatever.
It really doesn't matter that much. Okay. Anyway, 2 great questions, Duncan. What are we going to send them?
So we're sending them stickers. So this
Dope.
sticker right here that you can only get from
The
having
official
your-
laptop
your
sticker.
question. Yeah, yeah.
All right,
I
cool.
do have
Hey-
one other thing though. You asked for a photo of that coach. So there's the coach.
All right, we all look alike. I get it. I
coach
get it.
in
I get
Maryland.
it. I get it.
Yeah, he's the
fucked
new
up.
coach of Maryland. So yeah,
You really
I can
wanted
see
to
it.
wedge that in.
Wait,
I can see it.
All right, listen, great topics. Keep them coming. We read all the stuff that you send in, and Duncan picks the ones that he thinks will make for the best end of the show. And if we use your topic on the show, you will get a free official Compound laptop sticker. Thank you guys so much for watching the live tonight. We appreciate you. Great questions, great chat. Don't forget, tomorrow is Wednesday morning. You know what that means. All new edition of Animal Spirits on your podcast, and also here later in the day on YouTube. And we will see you guys later this week with an all new The Compound and Friends. All right, take it easy. Adios.